For more on this, we're joined by Xing Gan in Kuala Lumpur. She's a financial market strategist at Exness. Good to have you back on the program, Lee. Now, South Korean stocks fell into a bear market on Wednesday and are continuing to stay in the red. How concerning is that at the moment?
Okay, thanks for having me. I think that, definitely it's attention grabbing, but I wouldn't say that it's start of a crisis. I think a big part of this decline was driven by leverage unwinding within the AI bull market rather than a breakdown of the AI story. I think what's interesting about this sell-off is that it wasn't driven by weak fundamentals. We saw that Samsung reported solid earnings, whereas but both Samsung and SK Hynix also dropped. I think investors were reducing risk and unwinding leverage positions, right? And I think that's as opposed to reacting to the company's performance. I think encouragingly, right, foreign investors also turned net buyers after 2 weeks of selling, so it could signal that long-term investors see this correction as rather like a retracement rather than a prolonged downturn.
Right, and SK Hynix shares have rebounded after its US listing is said to have been 7 times oversubscribed. Does that reaffirm investor confidence in both the Korean stocks and the broader AI market?
I think it certainly reinforces confidence, but this deal that's being subscribed multiple times, it shows that global institutions still have a strong appetite for high-quality AI names, especially for companies that sit at the heart of this semiconductor supply chain. I think what's notable is the type of investors that we have that are participating, right? The offering is attracting sovereign wealth funds, technology-focused investors. So this suggests that it isn't a short-term speculation, but rather there is some longer-term conviction in this AI infrastructure narrative. I think that SK Hynix still remains the world's leading supplier in AI chips, right? It's directly benefiting from this continued investment in AI centers. But I wouldn't see this as an endorsement of this entire equity market. I think especially now with the geopolitical developments, investors are becoming more selective, right? And rewarding companies that have clear exposure to this AI spending would tend to benefit.
Looking at China, factory gate prices have jumped to a 4-year high while CPI was slower than expected. How should we be assessing this data?
Right, so I think that, on one hand, we have the CPI, or rather the PPI numbers that are hitting a 4-year high, right? And it reflects strong pricing power in the manufacturing and continued, demand from sectors like AI and advanced electronics. But at the same time, right, we can see that the CPI numbers has slowed, so it shows that households are still cautious and domestic demand hasn't fully recovered. So I think businesses are still finding it difficult to pass on this cost to the consumers. And it's also worth noting that even though we do see an increase on a year-on-year basis, right, we do see a retreat in terms of month-on-month basis as well, right, partly driven by easing energy prices over the past month. And I think it shows that, for policymakers, the focus would likely be on supporting domestic consumption, right, and also boosting demand.
Right, we'll leave it there for now. Xing Gan in Kuala Lumpur, thank you very much for your analysis.